The merge did substantially change Ethereum's economics. So did EIP 1559, which is that fee burning EIP that went live over a year ago now. But I'll try and be as concise as possible here because this does get quite technical and it does get quite lengthy if I start going into the deepest parts of this. But essentially, I'll contrast it with Bitcoin because Bitcoin has a very easy to understand monetary policy. That's why it's so popular, right? As you said, there is a maximum supply of 21 million that gets issued to miners every 4 years. The issuance halves from what it was previously, and that continues till the year 2140, where the last Bitcoin will be mined. Well, technically, the last Bitcoin will never be mined. It'll just keep halving, right? But it gets to a point where it doesn't really matter anymore. So that's Bitcoin in a nutshell, right? Whereas Ethereum has had an evolving monetary policy since Genesis. It had a certain percentage at Genesis, then there was an upgrade that reduced it, then there was another upgrade that reduced it. I think the first one reduced it from 5 ETH per block to 3 ETH per block, then 3 ETH per block to 2 ETH per block, and now with the merge, it's reduced that by about 85% at time of merge. So right now, I believe it's 4.5% or something of protocol rewards. So every single staker gets the same. Doesn't matter if you have 10,000 ETH or 32 ETH, right? You get the same. Obviously, in the ETH reward dollar denominated, it'll be different. You know, you get more rewards for staking more ETH, but the actual reward rate remains the same, which I think is really, really cool because it means that you don't have to have this massive industrial mining farm just to be profitable on the network as someone who validates or mines or stakes on the network, so to speak. But how that plays into the economics is that it means that Ethereum does not have a supply cap. And this is by design. Ethereum has prioritized predictable perpetual inflation so that we can keep paying the stakers forever, right? And then we offset that inflation via the fee burn. So as I mentioned, there is this thing called EIP 1559, which was an upgrade that went into the network over a year ago that burns about 70 or 80% of the total fee revenue of the Ethereum network forever, basically. Now, once the fee revenue reaches a certain point, it actually starts to 100% offset the issuance of the year, so to speak. So essentially what ends up happening is the issuance nets out to zero and then can go deflationary if the fee revenue is high enough, if the fee burn is high enough, I should say.
Anthony Sassano is perhaps the loudest and most OG Ethereum bull in the crypto space. Sassano is now extremely bullish on Ethereum post-merge, and in his latest 2 interviews breaks down why now, because of Ethereum's new supply dynamics, Ethereum is primed to explode in price. He has no doubt that Ethereum is the best risk to reward asset for investors that have a long-term time horizon such as 10 years or more. And with a successful merge and now Shanghai upgrade in the rearview mirror for Ethereum, his argument is extremely convincing. Despite the recent FUD and mudslinging towards Ethereum as an investment, Sassano believes that ETH will be the #1 asset to perform in the next bull market. Make sure to stick around to the end of the video where Sassano breaks down exactly how he thinks the next bull market will play out. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
But this is why Ethereum does not have a supply cap, because we think as a community that it's better to have predictable, perpetual low inflation, right? That pays to the validators on the network to secure the network, and then use the fee revenue to offset that instead of relying on the fee revenue to make up for, the dwindling reward. So I think, as I said, like Ethereum's monetary policy is much more complex than Bitcoin's. There's a lot more going on, but I think that complexity gives us a better system, in my opinion, than what Bitcoin has. And I think that as long as the inflation is relatively low, and it's basically, I mean, since the merge happened, fee revenue has actually been quite low because of the bear market, but the inflation rate of new ETH being issued, counting the burn, I believe right now is 0.15% or something per year. It's not even consequential because you just have to have enough money, new money coming in to offset that anyway, like to buy ETH and take it off the market. And you can even offset it by looking at how many people are staking their ETH. So let's say 500,000 ETH gets staked that year, 500,000 ETH gets issued. Well, that offsets it too. And then you have the fee burn that offsets it even more. So really, inflation is this kind of boogeyman word or bad word within crypto, but I don't think that should be the case. I think that as long as you have credibly low inflation that is offset by other means and is not changing all the time, we don't expect Ethereum's monetary policy to change from here, really. I mean, and if it does, it'd be because it was really important to change it. I think that's very, very important, rather than sticking to something that was decided arbitrarily by the original creator of some hard cap, when there's actually very real issues with that coming down the line. But that's my general view on it anyway. Ethereum's scaling strategy is multi-pronged, and it has been for quite a while now. And I won't get into these other networks that obviously have cheaper fees and why that's the case and all that sorts of stuff, because I could talk about that forever. I'll just focus on what Ethereum is doing to kind of fix its issues here. So as I mentioned earlier, Ethereum is trying to be this credibly neutral settlement layer, global 24/7 always online settlement layer. Now, to do that, it needs to restrict itself. It can't be everything to everyone. It can't just like keep scaling up and keep throwing more hardware at it and making it hard for people to run nodes and centralizing the network, so to speak. It can't do that if it wants to achieve that goal of becoming that credibly neutral settlement layer. So by understanding that, by realizing that, the Ethereum community has basically said, well, let's scale via layers. So let's scale via layer 2, layer 3. And there's a lot of these solutions actually alive today. And people may have heard of them: Optimism, Arbitrum, Polygon, Starkware. There's a lot of them now, right? I'm not going to list them all because there's too many now, which is pretty crazy, because a couple of years ago we didn't have any of this, and now we have a lot of them. And they're not just like existed as ideas, they're live, and there's apps on there, and they've reduced fees considerably. For example, on Optimism and Arbitrum, you can do a swap for like 10 cents, and that is actually running on Ethereum. They're not separate networks, they're layer 2s built on top of the Ethereum layer 1. Now that cost is going to come down even further as time goes on, as these networks themselves upgrade, as Ethereum, the base layer, gets upgraded to support that. Now, the merge itself didn't actually reduce gas fees. It wasn't meant to. It wasn't meant to be a scalability upgrade, but it laid the groundwork for what's coming next. So it's basically like when you're building a new high rise, you obviously lay the foundations, which are the most important parts, because you don't want the whole building falling over once you build everything on top of it. So we built the foundation with the merge, which was proof of stake Ethereum. And now over the next 6, 12, 18, 24 months, I mean, the Ethereum roadmap is quite long, but in terms of the next big upgrades coming, we have what's called proto-dank sharding, which is basically a variation of sharding, which has been talked about for a very long time within Ethereum. Now, sharding is going to be a base layer upgrade, but it is not for users on the base layer. It's for users on layer 2. So what it does is it doesn't reduce transaction fees on the base layer Ethereum or layer 1. It reduces them for layer 2s. So the layer 2 cost will collapse probably to under a cent per transaction, probably even less than that, right? And then users will sit at these layer 2s and do all their business there, and the layer 2 basically bundles up all those transactions and posts it to layer 1. That's how the layer 2 essentially works. Layer 1, base layer, keep it decentralized, keep it secure, keep it as that settlement layer, get the users on layer 2s, and let the layer 2s blossom. And I actually think that's a really cool way to scale, because what it means is that we have all these layer 2 networks that compete with each other. So they compete with each other to be better on fees, be better on speed, be better on just general user experience and apps and things like that. I mean, obviously not all of them are going to quote unquote win. There's going to be a pretty a normal distribution of where there'll be some really large winners and there'll be like a long tail of smaller networks. That we see that with everything in technology, but that's essentially how Ethereum is going to scale. So every single upgrade that's coming to base layer Ethereum got to do with scalability is meant for layer 2s. It's not meant for users on layer 1. And as I said, the reason we've done that is so that we can actually build Ethereum as that settlement layer, because if you start scaling Ethereum layer 1 for end users, you do what Solana has done, just as an example, because Solana takes the opposite approach here. Solana doesn't want to scale via layers. It wants to do everything at layer 1. Wow. But to achieve that, what they do is they throw hardware at it, right? They throw massive data centers at it. And then regular users can't actually run full nodes on their own hardware. Reliability issues and stability issues. We've seen it's very hard to keep a network like that alive because you're throwing so much at it, right? It just becomes overloaded. And essentially, the way I look at the Solana approach is the way the Web 2 has scaled, where they kept throwing hardware at it, right? There are software upgrades that have obviously helped with things, but they've had to do things like Cloudflare, like DOS control, right? Because when you have a centralized server, people attack it and then it can go down, it can fall over. So that's the approach that something like a Solana has taken, but Ethereum doesn't want to take that because, as I said, if we do that at layer 1, we lose what makes Ethereum special, which is the decentralization, the security, the robustness. Because the Ethereum network technically has never been offline. Not once in its entire life has it been offline. It technically has 100% uptime. The worst thing that happened to Ethereum was in 2016 when we had what was called the Shanghai DOS attacks, where the chain actually did get DOS attacked. There was a bug and it, I think, degraded performance by about 80%. But the network still was live. So Ethereum is prioritizing for robustness, stability, and reliability rather than scalability at layer 1, and then we'll move scalability to layer 2, and then everyone can do whatever they want at layer 2. That's the beautiful thing. You can do whatever you want at layer 2. You can manage your network the way you want it. You can put whatever you want into it. You can use whatever language you want. You don't have to use Solidity. It's awesome. And I actually think that scaling approach is much better than trying to do the monolithic approach where you just keep throwing hardware at it and eventually you hit a wall. Hardware doesn't scale infinitely. I mean, Moore's law is dead. Moore's law went from, I think, every 2 years to every 6 years now because we've hit that kind of wall in hardware scalability. So the only way to scale now is via software, which is what layer 2s do. But layer 2s also benefit from hardware scalability. And this goes into something like zero knowledge proofs, which people may have heard of, where you can actually put ASICs. So ASICs don't have to be miners. ASIC stands for application specific integrated circuit, which is basically just a piece of hardware that has a specific purpose. You can point ASICs at ZK stuff and you can prove these zero knowledge proofs faster and faster and faster, more economically. And that allows you to scale the layer 2 even more, cheaper fees for users. So essentially, Ethereum gets the best of both worlds. It gets the hardware optimizations at layer 2, it gets the software optimizations at layer 1 and layer 2. Yeah, so I love to talk about this, obviously, and there are so many reasons to be bullish on Ethereum post-merge. So, I mean, I'll start with the most obvious one. The switch from proof of work to proof of stake means that there's going to be a massive issuance reduction happening. So the amount of ETH issued yearly right now is over 4% under proof of work, and that's obviously quite high. Bitcoin is about half of that, I believe, right now at about 2%. But yeah, it's quite high, which means obviously there's more sell pressure from miners because they have to sell to cover costs. Like they have to sell a lot of it to cover their huge electricity costs and other maintenance costs. So there's going to be about an 80 to 85%, I believe, issuance reduction coming instantly at post-merge. And also, as I explained before, there's not going to be withdrawals for 6 to 12 months. So no rewards, staking rewards can be withdrawn either. The only thing that can be accessed are fees. So as a validator, you will earn fees. And those fees aren't new issuance. It's basically existing issuance being paid to you by people doing transactions on the network. So there will be a period of 6 to 12 months where zero new issuance will be hitting the market. And obviously that could potentially be bullish for the price because there's no sell pressure coming from those entities that have traditionally sold a lot of new ETH and put downward pressure on the price. So that's the most obvious, I guess, like catalyst of why you should be excited as an ETH holder going into the merge. And this is why people say the merge isn't priced in. We know that objectively the miners have to sell. Like this isn't a guess or anything like that. This isn't an assumption. We know for a fact that miners are forced to sell lots of ETH to cover their costs. It's not a kind of like a low cost business. It's actually a high cost business. Whereas even when withdrawals are enabled for stakers, they don't have to sell very much of their ETH because they don't have huge electricity costs. They don't have huge hardware costs. The only forced selling for stakers is taxes. And that's only for a subset of stakers, not for everyone. Obviously, some of them exist in kind of like tax-free places, but that's really the only forced selling that you would need. I mean, you could cover the electricity cost just from your normal job. Like it's not, the electricity cost is extremely minimal. It's basically just keeping a PC on 24/7, which I think most people do if they have a PC anyway. So really, like it's kind of like negligible over the course of a year compared to the rewards that you get. So that's the most obvious one. Secondly, I think it's going to shift the narrative around Ethereum pretty dramatically because we're going from energy intensive proof of work to green proof of stake. Now, I say those terms not as a crypto person. I say them as a quote unquote normie or a non-crypto person that we've seen it. Everyone hates proof of work because of the energy usage outside of crypto. That narrative is not going away. Right or wrong, it doesn't matter. What matters is the narrative. The narrative against proof of work is really, really bad. It prevents companies from wanting to adopt the technology. It prevents companies from wanting to work with the technology because their user base yells at them about it basically and says, you're killing the planet. Post-merge, Ethereum no longer has to worry about that at all, right? Ethereum is now a green network under proof of stake. It is objectively green because it no longer uses mining, and we can explain that to people. Now, whether they understand that or not is another thing, but I think that companies will understand that, and that's what matters because we want more adoption of the chain. Developers that are maybe very against proof of work will want to develop on Ethereum now, right? Because it's proof of stake. So that's a huge kind of thing coming as well. In my mind, that is a huge catalyst for Ethereum. The fact that we are able to put all of that to bed and basically be a green network as viewed by the outside of crypto kind of people there. So I think those two would be the biggest things that make me most bullish. The next two, I think, they're more kind of like, I guess, secondary effects, but probably make me just as bullish. So there is the staking rate, right? That kind of like real yield that you can get from staking ETH which will be, I think, post-merge, including fee revenue, even though fee revenue is relatively low right now, it should be about 5-6%. And then including MEV on top of that could be even higher. And that's an ETH-denominated real yield. If the merge goes well, which we expect it will because the last testnets went very well, there was no major issues or anything like that, there will be a massive de-risking event for Ethereum, and it will show the world that Ethereum can execute on massive roadmap items, because the merge itself is actually, for the foreseeable future, the biggest Ethereum upgrade in its history. There is no other upgrade that is as big, as complex, has as many moving parts as the merge. Everything else that is coming, sharding, vertical trees, statelessness, PBS, as I spoke about before, that's all relatively much simpler than the merge. So if Ethereum can execute the merge, and it can do so successfully with no interruptions to the network, it will be a huge de-risking event. And I think we're going to see a bunch of people buy ETH because of that, because the risk of the merge is now gone. It is running just fine. And that will lead to not only regular users, but also more big money institutions to pile into ETH as well. So the two primary and two secondary. There are other reasons as well on top of that I could go into, but maybe they're getting like too into the weeds. But I think that those things alone make for a very, very bullish ETH case and a very bullish Ethereum case going forward. And I think when you're looking at things being priced in or not, it's kind of like depending on your time frame. Like obviously, if your time frame is short to medium term, like it's impossible to kind of like say how priced in something is. I mean, for example, people were saying, well, the merge isn't priced in when ETH was like $3,000. Then ETH went to $800. And people say, well, the merge isn't priced in now. It's like, okay, well, there are a million different factors that determine the ETH price. The merge being priced in or not, to me, is a long-term thing. I've been writing about this issuance reduction that came with the merge since January 2019. So for me, for someone like me who has a decade-long time horizon, the merge is not priced in. But if your time horizon is 3 to 6 months, well, I mean, you could argue that there is some pricing in going on right now, because maybe it's a sell the news event, for example. Maybe that happens because ETH's run up so much and then people are like, well, the merge happened, let's sell the news. So it's kind of hard to know. And I don't really speculate on that. As I said, my time horizon is very, very long term. Like I haven't sold any of the ETH that I bought, and I don't plan to sell any of my ETH. I stake it all. But other people are playing this as a trade, and they're like, okay, well, yes, the merge is potentially bullish because of the narrative aspect of it, but once it happens, I'm just going to sell my ETH because the narrative of the merge is finished, that it's done. But then in my mind, it's kind of like, okay, well, you can have those sellers, but now you have no more selling from miners. You have the extremely positive narrative of Ethereum moving from proof of work to proof of stake. You have a de-risking event, a massive de-risking event that has just happened. And you have a real yield in crypto. I think it's going to be the only real yield in crypto, or at least one that's relatively high. That, to me, offsets all of that short, medium-term noise. And that's why I'm so bullish on ETH, and why people may see me on Twitter talking about it all the time, and why I'm stacking ETH all the time, is because when you take it in aggregate, there are so many reasons to be excited about not only the merge, but all the consequences of the merge after it, and how it all leads to kind of like the second order effects and even the third order effects and the downstream effects there as well.